It's time to take a look at the weekly market movers for next week, starting the 6th of February. And to help me do so, I'm joined now by a Senior Currency Strategist at Societe Generale, Lauren Rosborough. Lauren, thank you for joining me. Now, we have a rate decision by the Reserve Bank of Australia at the beginning of next week and a statement released by the Board on Monetary Policy at the end of the week. First of all, is the Reserve Bank of Australia still on track to cut rates next week?
The market certainly thinks so. At 4.25, the RBA had reduced interest rates, and in their last monetary policy statement, they did state that conditions were tight, and they did feel that going forward, a more neutral level for monetary policy would be appropriate. Now, this indicates a further reduction in the rate. The question is by how much. Most analysts are expecting 25 basis points in February, and then most likely to hold off from there. No doubt part of the reason for the RBA to cut rates last year was in light of the potential sovereign risks in Europe, and those for now have alleviated.
What about potential market moving data releases and decisions elsewhere in the world? What else should market participants bear in mind next week?
It's a very quiet week next week relative to many weeks that we do have, for example, this week. But what we do have is German factory orders, which will be very important given that the market's discriminating between core Europe, that being France and Germany, and peripheral Europe. So seeing continued sustained growth in factory orders will be very important, especially with the elevated level of euro-dollar. We've also got some more US jobs data, although that's not as important as the ones that we will have seen just this past week. There's a French sentiment indicator, which is a very good leading indicator for growth in France and growth in Europe as a whole. And once again, the markets will be focused on that. But really what the markets will be focused on, other than the RBA, is the Bank of England, which will round off the end of the week.
The Bank of England held the target for purchases at £275 billion in January and kept its benchmark rate at a record low of 0.5%. The central bank is expected to launch another round of quantitative easing next week to support the flagging economy. How much additional QE are you forecasting if this is the case?
The market's split between 25 billion and 75, and we're down the middle at 50. 25 really isn't enough. I mean, when you think about the market impact that we have had to date of 275, an additional 25 would mean that the Bank of England would have to undergo further quantitative easing. So bang for their buck in terms of market reaction and boosting the economy is quite limited. That said, once again, they don't want to put in too much into the economy because of potential inflation risks, and inflation is only just starting to fall or to soften. So we think 50 billion next week would be adequate with no change to the underlying rate at 0.5%.
And finally, let's discuss China. After better than forecast Chinese manufacturing figures, China PPI and inflation figures are also released next week, alongside various other data out of Asia, all of which will help support the notion of whether China is heading for a soft or a hard landing amid a hazy global outlook. What are your views on the Chinese economy?
China is slowing. They're actively trying to slow the housing market while at the same time trying to ensure that consumption growth continues. Now, those are two very difficult dual mandates to do at the one time. On top of which, of course, China's hoping to continue its export growth, and that depends on global demand, which is soft, but may not continue to soften. That does depend on what happens in Europe. On the inflation side, it's one thing that the PBOC has been focused on. We anticipate some further deterioration or softening in inflation towards 4% CPI, but that by no means will be a shock to the market. The risk is really if we do see either a much higher number than expected or a significantly lower number than expected. The difficulty with a command economy like China is that while they can try and influence the market and their individual state sectors, sometimes that doesn't happen immediately, and other times it happens quite soon. Consequently, the timing of when, a slowdown occurs is the general question that we have for China. Now, we expect that China will slow towards 6.5 to 7% growth. Now that's slow, but not stalling, certainly not stall speed. Nonetheless, there are risks of a bumpy landing, in particular if the PBOC have been too aggressive, and that causes some negative internal shocks to the economy.
Thank you very much for that market outlook, Lauren. Now stay tuned to Dukascopy TV next week for more market news and updates. Goodbye for now.